This is the Peter McClellen Show on Business 1570.
And welcome back to the Peter McClellen Show. If you're just joining us, we are privileged today to have with us Brian Parkinson. He is a mortgage banker with RMG, Residential Mortgage Group. And Brian, you're still seeing some crazy trends out there where people are perhaps being taken advantage of in their plight to try to stabilize financially. Tell us about that a little bit.
I've had conversations in the last 6 to 8 months with two different friends, prospects, in which they told me of their transaction. One gentleman had a first mortgage, second mortgage, lived in a townhouse. His value was lower than those two liens, and he wanted to take advantage of today's rates. He's always made perfect payments, and at that time I evaluated what he had, and unless he could get rid of the second mortgage, I had no options for him. I followed up with him a couple times. 2 months down the road, he tells me, I found an opportunity, Brian, with a company out of Arizona, and they're going to give me an option, or actually they have a program in which they will go in as a negotiator for me, and they're going to get me into a position where I can refinance, take advantage of today's market rates.
They have a magic wand.
They have a magic wand. Just happens to be out in Arizona, someone that you can't meet, look in the eye. And several months passed. 6 to 8 months later, I followed up with him. He sent $1,500 out to this company. It never happened. As he investigated the company to find out through the Better Business Bureau if they're reputable. He had some good feedback. He was getting good feedback, but it seemed as though he got farther into the transaction. Phone calls weren't coming back. Employees that he had talked to previously were no longer there. Just started to unravel. And ultimately he's out $1,500 at a point where he was 8 months ago. And for me, I've met a number of different people like that, where there are predators out there in this market that are going to find you in a vulnerable stage and take advantage of you. And to me, that's where you really need to talk to someone who's been in the business, that has a tenure and understanding of what is available, and get into a consultative opportunity with someone such as myself that you can trust, look in the eye, and evaluate and make sure that there is a program, so that at least an hour after I investigate, I can come back and tell you we have two options or we have no option, so you can get on with your life.
That seems to be the real value. You talk about service. You mentioned before we went on the air too about the idea that in this market, if you get a buyer or you get a transaction moving, the last thing you want to have happen is to have it gummed up by an elongated, and more costly. Tell us, there's expense if you go out 60 days, right? There's some expense that you could perhaps avoid, and maybe avoid having the deal go bad in the process.
The thing to understand in today's market is, think about these big box lenders. Now they have thousands and thousands of clients that are calling in because rates are really low, that want to take advantage to refinance.
Big box like Stagecoach, horses,
something like that. Sure, number of stars, something like that. Sure. But what happens is, nothing wrong with the refinance market, nothing wrong with taking care of your customer, which is always a priority for us. But what that does is that bogs down the underwriting service side of that company, which puts you to a point where you can't get through underwriting in a reasonable period of time. You can't get through the processing department in a reasonable period of time. So now, instead of being able to close within 30 days, you're closing. I've heard of some lenders that are locking 60 to 90 days out because they can't get the transactions through the system. What that means to the consumer is a longer lock is a higher cost to the customer, period. So if you're working with a company that's efficient, not the biggest, but the best, at getting your loan through the system in an orderly fashion, such as Residential Mortgage Group, when I meet with a customer, I'm letting them know we will close in 30 days or less from this date. Now,
you also talked about there's sort of a misnomer out there that sort of like going to Walmart. If you go to the big box lenders, certainly they're going to secure the best deal for you.
Well, that's what they would think. I met with a young couple in a purchase transaction, referred to me from a real estate agent because they had met with a big box lender, and they they were encouraged to get a second opinion. As we first sat down, I asked them why they were here. Well, we were told by our real estate agent we need to get a second opinion, and they referred you. Their thought process was, if I go to big box, it's similar to going to Walmart or Kmart. I'm going to get a better deal because big box sells everything on volume. And what they didn't understand, I am a product of a bigger lender. I spent 14 years with a very large lender. I was one layer of 5 layers of management. I grew the sales organization. I originated loans here or there. My job was to grow an organization. I had a salary. Where do you think the salary comes from? Where do you think advertisements on radio, TV come from? Brick and mortar, infrastructure. It doesn't mean that going to the biggest is going to give you the best rate.
See, I knew those big box lenders weren't any good because comparing it to Walmart, when I walk in, I don't see all the tattoos, the piercings, the people that fall into a tackle box.
And I hate that.
So,
well, understand though,
yeah.
A good mortgage professional is a good mortgage professional, regardless of who you work for. So I have great respect for all the lenders out in the market. It's just that I believe the structure of our company is set to benefit the consumer, maybe more so than some of my competitors. Mm-hmm. It's because I don't advertise. My business is all referral, word of mouth, relational, as opposed to a 1-800 or a mailer out to the customer every month in their payment coupon. So many great professionals for all the companies out there, but I truly believe that the structure of our company is a very big benefit for the customer.
Good stuff.
There's this misnomer that the big banks ripped us off for so long. Now this is our chance to kind of give them one. And so they've lost the responsibility of the documents that they signed when they bought the house or refinanced.
Yeah.
And I think that's a problem.
Oh, yeah, huge problem. And that's part of we also discussed this a little bit before, but the whole problem with what's going on in our country right now, and in terms of how this whole mess finally gets cleared up. It isn't cleared up yet.
Mm-mm.
All these toxic assets that have come back to the banks. I would think the big boxes are in some cases, I don't know where it's going to end. I don't know what happens.
Well, there's some pain out there. The one thing that I would really encourage consumers in this anti-bank mindset, we got to remember, if the banks aren't buying mortgages, I'm not buying a house. So the banks are still a very big part of being able to get homeowners into a house, because if they aren't offering mortgages, we're not buying houses, and hopefully housing will lead us out of this recession we're in, or have been in, they say. Eventually.
Yeah, eventually. I think it could take quite some time. I imagine with the glut of homes that are out there, it's a disincentive for new construction. Certainly, if you can go out and get something for a song, wow, why would you want to build? I don't know. But
you don't spend 10 to 15 years getting to where we've been and then expect it to correct itself in a couple of years. And I think a lot of people, that's their mindset. And I think we need to continue to weather the storm out.
Do you see, just curious for the consumer, because I like that you put it in context of a solid financial plan. One of the things that I'm hearing it from I have a lot of clients that are seniors that have, their kids have been affected by this. Their kids have mortgages. But I'm hearing that people are saving more. I'm hearing that they're using debt a lot less in general. Is that true?
Yes.
You seeing that?
Absolutely. I think I'm benefited from the clientele, the customers that I see. A lot of my customers have equity in their house, no debt, good jobs. They're taking advantage of today's times.
Are they communists? That's so anti-American. Good jobs.
They all live in Lakeville. They all live in Lakeville. No.
They all live in Lakeville. Okay.
Kidding.
I know. That's the way it's supposed to be, though, isn't it? That's good business. That's good for the individual, to grow your net worth and make it stable. I mean, if you start out totally upside down and you can barely make it, chances are you shouldn't be buying that house, right?
No.
I mean, and I just
one thing with first-time home buyers, before we even qualify, one of their assignments that I give them is, what's your current budget?
Nice.
How much do you want for your housing budget? And then how much money will you have over at the end of the month? I don't want you to fall in love with a $250,000 house if you should be buying a $150,000 house.
Yeah.
So we're going to get you pre-approved on the basis of, A, I know that you know what your budget is, and we're going to be reasonable and stay within what makes sense for you.
Oh,
they don't all agree with me on that, but it's very hard after they've fallen in love with a house to get them to crank it down so that it fits.
Even in this economy, and this, with so much uncertainty out there, people still get crazy with house fever.
Well, even to me, underwriting allows us to use 45% of your income to go towards your housing plus your debt.
45%.
45%.
Nice.
If you still run those numbers, I would not like to live at 45%.
No, it's way too high. What would you say is a good number?
I like the 35 to 36. Those were the old banking standards. They'd use 28% of your income towards housing, 36% when you add in your debt. I'd like to be below that. I've always chosen to be below that.
Personally, I'd like to see it at 25% on a 15-year. That's prudent.
Yes, it is.
Yeah, I'd like it that way.
Yep.
But again, it's not. I'm not saying you're bad if you don't do that. I'm just saying I want to see people be able to have, a little hamburger with their macaroni, and maybe even a steak once in a while. But you're not buying steak if you're doing it 45%.
No, you're right.
It's Alpo. It's not good. You were talking at the break about the fact that even if people did put 20% down, and they did it on a day when the rates were higher, and now they're considerably lower, there's sort of this feeling, oh, I'm stuck because now my equity is evaporating as the value of my house continues to drop. That may not be the case. Tell us about that.
May not be the case. There are some programs out there available through all lenders in which if you originally put 20% down and you did not have mortgage insurance premium, I can go out and identify if your loan is owned by Fannie Mae or Freddie Mac, if that's the case. And as long as you have 5% equity in the transaction, we can refinance you at today's market rates without higher closing costs.
I got to stop you there because we were talking about mortgages before, and how do you know if your mortgage is with Fannie or Freddie, if it's being serviced by AmTrust or
Great
whoever?
Question. There are actually lookups. Go to FannieMaeLookup.com
Really?
or FreddieMacLookup.com. You plug in some very basic information, and it'll tell you if your loan is owned by Fannie or Freddie. That's the first piece. The next piece is we identify who owns it. Now, there are cases where it'll come up, Fannie or Freddie say they don't own your loan.
Okay.
That's because it's held in a portfolio with a bank. In that case, you don't have this option. You'd want to go back to that bank and ask them, do I have any options to refinance? But I first start by looking at when did you originally buy your house? Can you prove you put 20% equity? Then I go out to these websites to identify if it's owned by Fannie or Freddie. Then I pull credit. Then we run it through a system which will also confirm they qualify for these programs.
Okay.
As long as I have 5% equity, I can refinance them at today's market rates with no higher closing costs. It's tremendous.
Well, I guess what I like about it is, pardon me, it sounds like you're attracting a group of people who are obviously serious. They've put 20% down, and that's a good thing. I mean, I think they have some skin in the game. So if there is some break, I don't think the break should just be people that have zero equity. Why not give people who have put money in and seen it evaporate? If they can get a better rate, why not?
That's the frustration, because today's consumer, in most cases, if they're looking for help on their mortgage, you can't get your lender's attention unless you miss 2 payments. Now they'll talk to you and talk about a modification. But this is the reward for those who have been making perfect payments, put 20% down originally, and now, unfortunately, they have less equity. I have customers that I called this week that are bringing in extra $3,000 to be at the 95%, but they're moving from a 5.75 to a 3.75 rate.
Nice. Very nice.
Great opportunity.
Well, Brian, it is a great opportunity, and I'd encourage people to contact you. What's your contact information again?
Call me at 612-282-5863, and please visit my website, brianparkinson.com.